You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
All right, it's official. If you are somebody who receives Social Security income, then you're going to get the biggest increase or the biggest raise in your paycheck in literally decades. Finally, right? But so why is this happening? Well, the answer is inflation. So we're going to spend a little bit of time today talking about the latest news on the 2021-2022 Social Security income cost of living adjustment, as well as a little bit about inflation, the stock market, and how to position your retirement portfolio to combat inflation in the future. But first, as always, a few housekeeping items. First off, thank you so much for joining us. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and above all, more educated than you were before you started listening today. So come back often and subscribe. These episodes appear on both iTunes and YouTube. And you can also follow me on Twitter at Adam Koch and on Instagram at Financial Surgeon. And last but not least, all links, visuals, charts, and additional educational resources are always available on our website in the Education tab. So let's go ahead and jump in here and get started. I always like to start with a quote every single time, and I think this is so appropriate. The quote is Sam Ewing. He was a baseball player in the major leagues. He said, "Inflation is when you pay $15 for the $10 haircut you used to get for $5 when you had hair." I think that's awesome. Anyway, but yeah, I'll repeat it one more time here just because I think it's hilarious. But inflation is what you pay $15 for. I'm sorry, inflation is when you pay $15 for the $10 haircut you used to get for $5 back when you had hair. So that's what inflation is, and most people don't understand why inflation occurs. I think most people think that prices just go up over time, and that's just how things are supposed to be. And that's not true at all. In fact, there was a time earlier in American history where prices used to go down. Think about the fact that back when the Model T came out, and all these things like cell phones. Cell phones, it used to be so expensive to buy one and have one in your car. In fact, they were called car phones. They weren't even called cell phones. And the prices of those things eventually came down due to efficiency and bringing costs down. And when it came to production, and we would see the prices of lots of things we buy going down in value. But a lot changed. And back when the dollar was debased from gold, the gold standard, all of a sudden we had this floating U.S. dollar that would float depending on the supply and demand of the number of dollars that are in circulation. So, in other words, if you have more dollars, then the dollars in existence are worth less. And the joke is that they're not worthless, they're just worth less. So the more dollars you have, the more dollars it takes to buy the same stuff, which is why prices go up. So didn't really plan on verbal vomit there, but that's basically inflation in a nutshell. But let's talk first about the Social Security income cost of living adjustment. So what's happening here? Well, this past week, the decision was officially made, and 70 million Americans are going to see their Social Security income benefits rise by 5.9% in 2022. To give you some perspective, in 2021, so this year, the increase was only 1.3%, and the year before, the increase was only 1.6%. So this year, again, 5.9%, almost a 6% bump in Social Security income for everybody who receives or is a beneficiary of Social Security income or supplemental income. And again, more perspective here. The 5.9, or call it 6% if you will, 5.9% increase. It's the largest jump since 1983. And back then, Social Security went up in 1983 to the tune of 7.4%. So this is a big deal. Now, on one hand, it's good, right? Because we want to see people getting more income and making sure that they can live the lifestyle that they want to live, considering inflation has been taking hold. Things like food and obviously lately cars, supply and demand problems with vehicles. So we want to make sure that our people who are on Social Security have enough money to pay the bills. But the problem, of course, is that the reason why cost is going up is because of inflation, of course. Now, just a couple details here. The inflation adjustment, or I should say the cost of living adjustment on Social Security is going to go in effect between December and January. And when that takes place, you'll see your check. If you're a beneficiary of Social Security income, you're going to see your check go up, again, to the tune of about 5.6%. Now, when we look back over time, again, looking at history, looking at inflation, there was a time back in the late 2000s when we had a bump, close to that, 6% number. And then again, in the early 90s, we had Social Security had a nice little bump to the tune of about 4 to 5% between the I'll call it late 80s, early 90s. But it really wasn't, you'd have to go all the way back to 1980, 81, 82 to see these big, huge jumps in Social Security income. And again, if for those of you who remember or who study economic history, the 80s were when we had huge interest rates, huge inflation. In fact, most don't realize that the reason why interest rates were so high was because of inflation. So we'll often hear people say, oh, I miss those old days when, CDs at the bank were paying 14%. And it's like, well, yeah, okay, 14% CDs do sound incredible, right? No market risk. You don't have to worry about losing your money. They're guaranteed by the federal government, insured by the FDIC, paying, say, 14%. That's wonderful. But guess what? Your mortgage is 16% and inflation's 18%. So you're actually losing money to inflation, even though you've got a nice big, what seems like relatively high CD at the bank back in the 80s, call it 14% or what have you. So it's all relative. Granted, today you can buy CDs at the bank. They're putrid. The rates are horrible. I was just looking the other day at a fixed annuity, trying to find the best rate I could for a very, very, very conservative client who wants to have a portion of their money literally taking no risk, but the best guaranteed rate they could get. And the best rate I could find was 1.5%. This was about a month ago. 1.5% for 5 years. And the funny thing was, or it's not funny, I guess, but it's kind of funny, is that 5 years was 1.5%. But if you went out to 7 years or 8 years or 10 years even, the rate was 1.45. So by giving your money away for longer, there was actually lower rates if you lock your money in for longer, which makes zero sense, right? But anyway, I digress. So first and foremost, we've got this Social Security bump. It's one of the biggest in decades. That's awesome. But we've got a little problem with inflation here. So you can, if you're looking at YouTube, so on YouTube, I've got a chart here. It's the year-over-year change in the Consumer Price Index, or CPI, and this is what most use to measure inflation. Now, some measures of inflation do not include food or energy, and obviously the things that we eat and gassing up our cars and things like that are some of the most, we'll call it a big chunk of how we spend our money, right? Because we need to survive, we got to eat, obviously. But when you look at CPI and you go back to 2020 and the COVID recession, you can see inflation was really, really, really low. I mean, we're talking deflation because people just weren't spending that much money. We weren't. There wasn't a lot of travel. People were eating at home, maybe a little bit of DoorDash, Grubhub, and Uber Eats here and there. But aside from that, things were very, very, very. People were being conservative with their money, obviously. They were saving money. People were losing jobs. So some of the reason why certain Fed presidents think that we're seeing inflation in 2021 is because it's a temporary, transitory time period where we're rebounding off the COVID lows. So that's one theory. One theory is that this isn't real long-term inflation that we're seeing pick up. This is just a transitory time where things are just, think of it like a rubber band, where because things got so bad during COVID, and because inflation was so low during COVID, that it's like you stretch that rubber band and then it's kind of snapping back and snapping the other direction. The other opinion is that because of COVID and because we have spent a lot of money as a country, that the more dollars we spend, the more debt we have, the more dollars in circulation, the more money it takes to buy things. And you combine that with higher minimum wage. When you have higher minimum wage, companies have to pay people more, and the things that those companies produce then have to go up in order to keep those companies from going out of business. No company that's profitable anyway, or that wants to stay in business, is going to increase their minimum wage without increasing the cost of their products, unless they have such huge margins to where they could afford to do so. But that's not most companies. So at the end of the day, it's the other theory is that this is actually going to be real inflation, understanding that the last, call it 2-3 decades, all we've seen is 2.5, 2.6, 2.8% inflation, that maybe we're actually going to see some real inflation going forward. So one of the questions is this the new normal? Inflation, like I just mentioned, inflation has wavered between 2 and 3% for decades now. I mean, here I am. I've been doing this, for, a financial advisory firm. I own this firm for, 20 years now. I've been in this business, and I can go all the way back to high school, middle school in the 90s when we didn't have inflation then. Even when I hadn't even gone to college yet, we weren't seeing inflation yet. And again, some of these issues are supply and demand. So when you look at the automotive industry, for instance, if you drive down the street and you look at any new or used car dealership, you're going to see that there's not a lot of cars on the lot. And a lot of that has to do with the fact that there's not enough semiconductors to put in the cars, because all these cars these days are run by computers. It's not like the old days where you had carbureted cars and if you couldn't start them, then you just spray something in the carburetor and get it moving and choke it up, and that's it. You're done. But these days, every car that's made is run by a computer. So if you don't have semiconductors and microchips to inside the computers, inside the engines, the cars aren't going to start. So something that's going to be really interesting to me, anyway, is when we look at 2022 to see how many cars that are not 2022 cars, but 2021 cars. So cars that have been sitting out on lots, for months, maybe even a year or more, that could not be sold because there weren't any semiconductors to put in those cars, that when we start to see the supply chain catch back up again, that we're going to be buying quote unquote new cars that are technically a year, in some cases 2 years old. No miles on them, of course, so technically they're not pre-owned or used cars, but I would not be surprised, I guess, to see a glutton of cars hitting the market. And this isn't just in the case in the automotive market. This is the case across the board when it comes to a lot of things around the world. As COVID hit and companies, factories, supply chain just got locked up as people wouldn't go to work, and there just wasn't enough product being produced. You saw that in the lumber industry as well. My parents had been renovating their home, their retirement home at Buckeye Lake, and all of a sudden lumber prices go through the roof because many of the lumber mills shut down. And for those that stayed in business, or at least stayed open for the majority of the time, they cut production dramatically. And then you have people that are sick. They get COVID. You got to quarantine. Maybe they're around somebody who had COVID, so they have to quarantine, even though they never even got sick. So this is what's happened this last, you call it 18 months or so, maybe even creeping up on 2 years here. And then if we have lower supply, think about this. If we have lower supply, but we have the same or worse rising demand, then we have to have higher prices. Even if demand does not go up, even if demand stays static, if we have a lower supply of product available, then prices must rise. It's just the irrefutable law of supply and demand. Now, if you add on top of that rising U.S. government debt, we're pushing $30 trillion in government debt now, and we could find ourselves in a position where we have two choices. We can either inflate our way out of it, which is the better choice, obviously, but because the other choice would be telling countries that have lent us money or purchased our debt that we just don't feel like paying them back for a portion of that money, or writing off a portion of that debt. I just don't know any other way that it can happen, and I think that the safest way, not to mention the best way politically to get this government debt paid off, is going to be to inflate our way out of it. In other words, as inflation goes up, and there's more dollars in circulation, it takes fewer. We have so much inflation. We can pay that debt off faster as a result of inflation. So if the U.S. dollar goes down in value, then we can pay that debt off faster than we otherwise would. Now, what happens to stocks during times like this, during inflationary period? And by the way, let me step back for a second. I'm not predicting that we're going to go through a multi-year or multi-decade period of inflation. I have no idea what's going to happen, and anybody who tells you that they do is lying because they don't know. But I think what we want to do is not predict what's going to happen or anticipate. I just think we want to prepare for it. I think we want to be prepared for all circumstances and all situations. So as long as we have muted inflation, as long as we have a flat to strong dollar, then I think it's okay for us to stay leveraged in U.S. stocks. I think depending on the interest rate environment, we have to be really, really careful with our bonds, and I'll hit on that in a second here. But if we do end up in an inflationary period, if we do end up with a falling dollar, if you go back to the 1910s, 1920s, there was a multi-year period where inflation was very high. Between 1910 and 1920, about 6%, just north of 6%. And during that time period, the Dow Jones Industrial Average, was only up 0.9% per year, 0.91 to be exact. If you fast forward to 1970, 1980, that was another period of high inflation, call it 6.55%, so just over 6.5%. And during that multi-year period, we had an annualized return of the Dow of 0.47% for a very long period of time. Basically, the market went nowhere for a long time. So now here we are after decades of very low inflation, so again, 2 to 3% on the high end. The question is, are we going to end up in an inflationary environment? And if we do, then what? What do we do? What do we do in the case that we do find ourselves in an environment where we have a falling dollar, we have inflation, and here are the things that I think we need to be thinking about. In the case of a falling dollar, U.S. stocks are probably going to struggle simply due to exchange rate risk. And what I mean by that is, let's just say we have a $100 stock here in the U.S. So it stock's $100 per share, and we have a $100 stock overseas, and we'll just say in England. If let's just say the U.S. dollar falls relative to the pound, and it falls by 5%, I'll just say, then that would mean that the U.S. stock here in the U.S. would go down on a relative basis. It would go down 5% relative to that stock. So all things held constant, the same $100 stock overseas is now worth 5% more merely due to exchange rate alone. So if we have a falling dollar, then international stocks are probably going to look good. This is going to, this would look a lot like, let's just say 2003, 4, 5, 6, 7, and 8. So between 2003 and 2008, that was a time period when international stocks did very well and outperformed U.S. stocks. If we're in an inflationary environment, another thing that tends to do very well are commodities. This could be soft commodities, agricultural commodities, energy, so natural gas, oil, heating oil, natural gas, and then even precious metals, so gold, silver, and so on. If we have shifting away from inflation to interest rates, this is a kind of a separate concern. It's the opinion of many of us, when I say us, me and my friends in the portfolio management business, that the government is not going to allow rates to go up too high too fast. In fact, we wonder if they're going to let rates go up very high at all for the foreseeable future, simply because we wouldn't be able to afford the interest on our debt if they were to go up too fast or too far. So when it comes to interest rates, the biggest concern that you need to have in your retirement portfolio is the bonds in your portfolio. When interest rates go up, bonds go down. It's not a matter of speculation or anticipation. That's how it works. The longer the duration of the bond, the more it hurts when interest rates go up. If you've got 30-year bonds, long-term bonds, it's going to hurt more. If interest rates go down and you've got 30-year bonds, or your average duration is, call it 20 to 30 years, then you're going to make a lot more money than, say, you would if you own short-term bonds. So the longer the maturity, the more the fluctuation, the more the volatility. But the problem we're running into these days, and when I say these days, I mean the last few years, is that we've been going through what might look like a bottoming process in interest rates. Now, interest rates don't bottom like the stock market. The stocks, they'll go down, average crash, say 16 to 18 months. And when the market finally crashes and bottoms, it typically does so relatively quickly and starts coming back. So even if you have to wait 18, 24 months to see the market go down, say 40 to 50%, the bottom is quick. Whereas interest rates are a little bit different. If you look back at history, interest rates bottom over a multi-year period. So we're in this period right now, I think, where we're going to see a lot of bouncing around in ranges, where interest rates go up, for several months, and then they go down for several months, then they go up for several months, and they go down for several months. So it's going to be really, really difficult to have bond portfolios right now where you're just staying invested in bonds and that's it, and you don't make any changes. I think you're going to have to look at other things like convertible bonds. I think it's going to be important to observe things like Treasury inflation-protected securities, which go up when inflation goes up, floating rate, which goes up when rates go up. Another thing that you can do through what are called inverse ETFs is you can actually short bonds, which is kind of like owning the rate. So if rates go up, bonds go down, but if you short bonds, when rates go up, bonds would normally go down, but your ETF or your investment would actually go up in value. It's not risky. It just means that there's no way to own rates. You can't just go out and buy interest rates on the open market unless you're investing in futures, which not many people do. So that's the other thing that I think you really need to pay attention to. So to sum things up here, again, Social Security income going up almost 6% this year between December and January. So our Social Security beneficiaries are getting a raise. Second of all, the reason for that's inflation. Third, what do we want to do about inflation? Because that's a concern, obviously. Well, we want to be paying attention to our retirement portfolios. We want to make sure that we're positioned in a place where if we continue to see inflation, then we need to maybe start looking into other areas of the market, whether that be commodities, international stocks. And again, when it comes to our bond portfolios, we just want to be generally careful overall to make sure that we're not staying invested in what was, say, historically perceived for the last several decades as safe, or to consider bonds just a safe place where you cannot lose money, which is definitely not the case. So with that all being said, that's it for today's show. Be sure to share this episode with your friends and family if you think they would benefit. And if you'd like to discuss your personal situation further, remember that you never have to be a client to ask a question. So if you'd like to set up an introduction call, email us at info@libertaswealth.com, or head over to our website and our contact page at libertaswealth.com. Be the first to watch and listen to these episodes by subscribing both on iTunes and YouTube. And don't forget, if you head over to libertaswealth.com, you can sign up to get these updates, but also all our other screencast videos and articles, and have them delivered directly to your email inbox whenever they're released. Feel free to follow us on Facebook. I'm also on Twitter at Adam Koch, as well as Instagram at Financial Surgeon. And as I always say, there are thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.